If you've been tracking the electronics manufacturing space lately, you know it's a completely brutal market to navigate. But every once in a while, a company just completely rewrites the script. Today, we're diving into this explainer to unpack the unbelievable Q1 2026 performance of Benchmark Electronics, a quarter that caught Wall Street entirely off guard and sent the stocks surging. Let's break down exactly how they achieved this, piece by piece. $87.83. That is Benchmark's all-time high stock price, hit right on the heels of this wild Q1 report. Today, we're looking under the hood to figure out exactly what triggered this massive breakout. We aren't just looking at top-line revenue here, we're exploring the strategic shifts, the market moats, and the internal machinery that allowed a mid-sized player to completely dominate their quarter.
Section 1, Anatomy of a Breakout, Q1 Financial Highlights. Let's start with the headline numbers that honestly caught the entire market off guard.
So here's the crucial takeaway. Look at how they managed to turn a perfectly solid 7.2% bump in revenue into a staggering 257% explosion in net income. Revenue went from $632 million to $677 million, which is good, right? But net income? That jumped from $3.6 million all the way to $13 million. Diluted EPS rocketed up 260% to 36 cents. I mean, this is basically the holy grail of business operations, when your profits are growing exponentially faster than your sales. It tells us that the revenue coming in right now is of a much higher quality, with way better margins than what they were booking just a year ago. And this definitely wasn't an accident. As CEO David Mozidis pointed out, this is the validation of a massive strategic pivot. Basically, over 2 years ago, Benchmark made the conscious decision to walk away from the low-margin, high-volume bloodbath that is standard consumer goods. They realized they just couldn't and really shouldn't compete on price alone with those massive overseas factories pumping out cheap electronics. So instead, they went all in on high-complexity, mission-critical systems. Now, what's truly impressive here is their cash conversion cycle. They literally shaved 19 days off year over year, bringing it down to just 67 days. This is huge because it proves their super disciplined inventory management is feeding directly into the bottom line. Inventory days dropped by 14, and their inventory turns saw serious improvement. When a company can move parts through a factory and convert them back into cash this efficiently, it frees up millions in working capital. Actually, they generated $47 million in operating cash flow this quarter alone. Moving on to Section 2. Sector drivers across AI, medical, and semi-cap. Let's look at the engine actually driving these numbers. Benchmark has engineered this beautifully balanced exposure across mission-critical sectors, which totally protects them from the classic boom and bust cycles of consumer electronics. Semiconductor capital equipment leads the pack at 28%, followed by industrial, medical, and aerospace and defense, which are all hovering right in that 18 to 20% sweet spot. Finally, advanced computing and communications, or AC&C, rounds things out at 15%. It's a great setup. If one sector softens up a bit, the others can easily step up and carry the weight. But the real stars of the show here, these segments actually pulling those heavy growth levers, are a 24% surge in medical and a massive 41% jump in advanced computing. And what's driving that 41% spike? Well, the CEO explicitly called out that new enterprise AI cluster ramps are officially underway. Look, as the world races to build out AI infrastructure, these companies desperately need complex, liquid-cooled, high-performance hardware, and it has to be assembled with absolutely zero room for error. Benchmark is just perfectly positioned to catch that wave. And winning this award, HP Enterprise's 2026 Manufacturing Partner of the Year, is a massive signal that their on-prem cloud infrastructure and high-performance computing strategies are absolutely hitting the mark. When a giant like HPE names you their top partner, that's essentially a neon sign to the rest of the industry that your quality control and engineering chops are truly elite. Section 3, the competitive edge and building the moat. So how exactly does a mid-sized player defend these high-margin wins against giant Tier 1 competitors or cheaper entrants overseas? Well, they've built this incredible moat by focusing on what's called high-mix, low-volume manufacturing. We're talking about complex, highly regulated engineering where embedded intellectual property creates these massive switching costs for their clients. Think about it. Once Benchmark integrates its proprietary RF and microelectronics design into a customer's aerospace system or medical device, it is incredibly painful and expensive for that customer to rip it out and switch to a cheaper manufacturer. You add in their strict global aerospace and medical certifications, plus a strategic nearshoring footprint in Mexico and Arizona to catch that China plus one supply chain trend, and you've got a heavily fortified competitive position. And this strategic moat translates directly into real operational excellence. By heavily investing in smart factory tech and predictive supply analytics, they actively reduce the impact of component shortages. This directly led to a 15 to 25% improvement in their on-time delivery metrics. And in the high-stakes world of defense systems and medical robotics, delivering on time isn't just a nice little bonus. It's literally the most important metric for holding on to a contract.
Plus, they aren't just sitting on their cash either. They're using their $29 million in free cash flow to expand. Their Penang 4 precision technology facility over in Malaysia is right on track to open in Q3 2026. This expansion is specifically designed to ramp up their high-margin semiconductor capital equipment capacity. They heard the demand signals for a recovery in domestic chip production equipment, and they are literally putting steel in the ground to meet it.
Section 4. Following the smart money in a market tug-of-war. With all this incredible execution, let's look at how the market is actually reacting to this. Because there's a fascinating tension building behind the scenes right now. We have a real tug-of-war going on. On one side, huge institutional hedge funds are just gobbling up shares. Earnest Partners recently added a massive 1.75 million shares, a position worth nearly $75 million. But on the flip side, company insiders are quietly taking profits. CEO Jeff Banks sold 60,000 shares, and we've seen 12 total insider sales over the last 6 months with 0 insider purchases. Now, to be fair, it's completely normal for executives to take some chips off the table when a stock hits an all-time high. But the stark contrast between that aggressive institutional buying and the insider selling, that's definitely something we need to keep a close eye on. But even with that insider selling, management just raised their full-year revenue growth outlook to 9 to 10%. Remember, they had previously guided for just mid-single-digit growth. Bumping up the full-year outlook right out of the gate after Q1 is a move that signals immense internal confidence. They're clearly seeing the semicap market rebounding, their defense and space bookings remain super strong, and those AI-related computing ramps are officially rolling out. So the ultimate question to leave you with today, as their precision tech facilities come fully online later this year, and that massive operating leverage really continues to take hold, have we only seen the beginning of this breakout? If they can turn a 7% revenue growth into a staggering 257% profit growth, what happens when their top line accelerates to 10%? That is exactly the question the market is trying to price in right now. Definitely keep your eyes on the supply chain story.